Good evening, everybody. Welcome to tonight's webinar brought to you by Bursa Malaysia. So we are on the fourth episode of a series of webinars brought to you by Bursa Malaysia. It's an investment educational webinar. So, we have a lot of fundamental analysis which is being shared by Alvin. And today is the first day we're going to talk about chart analysis. All right. So we will continue to have a second one as well, in the near future. So please do stay tuned with us. If you are first time on our Facebook page, please do like our Facebook page so that you are able to get notifications whenever we go live. All right. So it's a special webinar today. It's an educational webinar so that you are able to equip yourself with the skills and knowledge to be a well-informed investor. Right. That's what we want to achieve, and that's what Bursa Malaysia want to achieve as well. All right. So today's topic, we're going to talk about how to make timely investment decisions, right? Looking or riding on price charts. So I'm going to basically share with you first, why do people use price charts? How you can look at price charts to make timely investment decisions. But before that, you need to know the mechanics or the reason why people use price charts to make that investment decisions. All right. So guys, if you can hear me, just say yes so that you are able to hear me loud and clear, then I can continue. All right. Thanks, Arul, for joining in. Mayapan, YFCO, Limars, Aslami, Himin Pang, Ken Mas, Ken Mays. All right, you guys. You have quite a number of regulars over here today as well. So thank you for joining us tonight. While we're still waiting for the others to come in, I'll just gonna go through with you a few announcements before we start. All right. Thank you, Jatinda. Thank you, Rin. Okay, great. So we can start right now. All right. Okay, I hope that today's workshop will able to give you an idea about how you can use price chart analysis, and also how, most importantly, is basically how you apply them. All right. We have actually gone through a few of our sessions earlier as well. That one of the ways to, of course, when we look at fundamentals, is basically to look at what company to buy. All right, which company that's able to provide you with some sustainability and growth, so that you're able to invest in them in the long term. All right. But we do not cover much on the timing side because if you go on the long term, you really do not really need to look at the timing part, right? But if you are trading for the short term, which means that your objective is for short term profits, then of course timing will be very important. All right, because you do not care. Your objective is not really to buy and hold in long term and to invest in the company in long term. Your company is to trade those shares, all right, to make profits whenever there's a capital gain. All right. And of course, for every trading or even investment, there are always risks, right? So we're going to also address, right, why, if you are able to use techniques like even charting or technical analysis or fundamental analysis, what we are trying to basically do is to lower our risk when we ever make trading decisions. All right, it's all about minimizing your risk as much as possible and maximizing your profits. All right. So there is no such thing as there's no risk, lah, but we want to minimize it as much as possible. And that's the reason why we are data driven. We look at information and data to make information or to make investment decisions. All right. That's how you become a well-informed investor. Okay. So let me just share my screen. Okay. So today's topic is about how to make timely investment decisions riding on price charts. We all know that the market has been really bullish in the past 1 week, right? Basically, since the past 1 month, it has been going up. It's been the market goes into a correction, but it's now starting to move again. So how are we going to ride on these price charts, right? Most of the traders or even sometimes investors think that we always have to buy at the bottom to make money or to make profits, right? You have to really buy the bottom, but what happens when the price is already moving into an uptrend? So where is your opportunity, right? So there are actually ways to try to ride on a trend that has already existed, right? It doesn't mean that if you miss the trend earlier, you should miss the next one. Okay, so it's important, if you know about charting or technical analysis, then at least you know where are the points for you to continue riding on its trend. All right, that's what we want to achieve today. So before we start, whatever that is being discussed or shared here today is for informational and educational purposes. It is not intended as any investment advice or whatsoever. All right. And guys, if you have any questions at all when I'm presenting, you can put those questions down there on the comment section so that I'll be able to answer you guys if you don't understand whatever I'm presenting, or if you need any clarification from the presentation itself. All right. Now, I'm going to start with technical analysis. Why do we use charts, right? Now, when you look at price charts, right, something which we actually learn in high school, but we do not take it seriously, right? When we talk about statistics, we talk about demand and supply. Yeah, we know how to use it, we know how to apply it, we know how to do the calculation, but basically we do not know what's the reason why we do all this, right? Until maybe we are when we are working, or maybe when we are trading in the markets, then we know that statistics are very important. All right. So when we look at price chart, it's all about price and time, because on the price chart you have that, the price axis, and you also have the time axis. So there are two things that you can forecast, or there are two things you can analyze in the price chart. One is price, okay, one is time. Okay, so price analysis. So normally people who only look or analyze at price movement, like how high they're gonna go or how low they're gonna go, those are price analysis. And of course, the other analysis that not many people do is called a cycle analysis. All right, to tell you time, when is the market moving, when it's not moving, when it's going sideways, and so on and so forth. So you have actually time and price, okay, because it's a price against time chart. Now, when we talk about demand and supply in statistics, in economics, we always learn about finding the equilibrium, right, where demand meets supply. Okay, but because a stock market is so dynamic, there is no fixed equilibrium, right? There's no fixed demand equals to supply. It keeps on changing, and that's the reason why prices are volatile. It does not stay at one place. All right. So what are the factors that determine price movement? Why is it so volatile? Okay, there are a lot of factors. Okay, one can be news and announcements. Okay, market speculation, because the market is the one that sets the price. Okay, sometimes the market can just be by speculating without any reasons. The price can actually go up, right, or go down. Okay, it can be company's performance. Okay, they will give you financial results every quarter, and you look at the quarter, and when the results are better than expected, price goes up. But if it's lower than expected, then the price will come down, and so on and so forth. Okay, so we also have economic and social factors that affect price movements as well, right? Of course, natural and man-made disasters. Natural disasters like what we've seen recently. We have the COVID-19, which is a natural disaster, for not really natural disaster, but it's actually a health crisis, right? That affects not just the Malaysian market, but the market worldwide. Okay, so this affects the markets as well. Okay, and then the different kind of players in the market. There are long-term investors, short-term traders. All of them, when they collide, when they start to trade against each other, of course, it affects the price movements. All right. So if you really want to determine, the right price, or where it's going to go, or how high is it going to go, or how low is it going to go, you basically, if you want to look at the fundamental factors, you really have to dig in into this information. All right. And of course, some of this information is not easy to get, lah. So it's really difficult to get all this information to determine what's the next price move. Okay, so that whatever these factors, right, affect the market, it will basically affect the price, right? Demand and supply basically affects the market. So if there is more demand, for example, if everybody wants to buy that share and very little people want to sell that share, the price will go up. Okay, it can be a share, it can be a commodity, it can be basically anything, lah, right? One easiest example is, I'm going to put a durian example, because all of us love durian, maybe for some, lah. Okay, when everybody is going to buy durian, when demand of durian is very high, price definitely goes up for durian. But right now, you can see prices of durian goes down. Why? Because there is not much demand, right? There's a lot of supply, there's ample supply. They can't, some of the durians has been exported, but because of COVID, they can't export it out. So there's plenty of durian right now, and it's cheap. All right. So demand and supply affects the price of that particular instrument, whether it's stocks, whether it's commodities or indices or so on. All right. So price change because there is a difference in opinion between in a particular instrument or a particular stock. So since today we are talking about the stock market, so I'm just going to refer everything into stocks. All right. And there are basically two opinions in the market. There is a bull opinion, there's a bear opinion. All right. A bull expects price to go up, where a bear expects price to go down. Right. These opinions are the one that basically, when they interact and when they start to make decisions in the market, it will affect share price movements. Okay. Now, the sentiment, the opinion can change. Some can change from bull and bear depending on the information that they receive. All right. And I also know some people who are actually like, once they are bull, they are permanent bull. And they are also permanent bear. That means they're always pessimistic about the markets. Right. And there are people who are always optimistic about the market. Now, because market is dynamic, right? Of course, if you look in the long run, I mean, we are talking about 10 years, 15 years, 20 years. In the long run, market is bullish in general, right? If you look at the whole performance of all stocks in Malaysia, not all are, right? Some good ones. Okay, generally their prices will continue to grow over the years. But between that period, there are volatility, right? The price goes up and goes down, and it can be affected by many different factors. Okay, but generally the market is always divided into two opinions, bull or bear. So if there are more bulls in the market, then price generally go up, right? Because their decision is always to buy, and buy more. So demand goes up. Okay, bears are basically people who are intending to sell because their opinions are basically going down. Okay, and the market also comprises of many different players in the market. There are financial institutions, there are hedge funds, there are insurance companies, there are retail professionals, there are speculators, there are even gamblers, right? People who just go there, and just try their luck and see whether they make money or not. Basically, there are many people who can actually invest and trade in the markets. All right. But what we want to basically know is where the big money is. Okay. Now, in terms of number of participants, all right, we probably have more retail investors, number of participants, than institutions, all right, because we are talking about number, every single individuals. But one institution, the value that they may transact in the market could be many times more, 1,000 times, 10,000 times more than one individual, right? So although the institutions by number is smaller, but the value or the volume they may create in a market is much bigger than the retail market. All right. So it's very important to see where the big money goes. Now, of course, it's very difficult to know what they are doing. Okay, and one of the ways is to track them using price and volume movements. All right. So there is some, of course, whenever we analyze chart, there's always some assumptions that we make. All right. So that's why it's not 100% accurate indicator, but we try as much as best as we can to understand the markets and to lower our risk. Okay. So whenever the bulls and bears make decisions in the market, they will affect the price. Okay, if, like I said earlier, if more demand, then price goes up. If more supply, then price comes down. Okay, so I mentioned this one already. So again, right, if there are more bullish opinions than bearish opinions, if most of the people want to buy, then price generally goes up. Right, if more bearish opinions and people start to sell and most of them start to sell, then price generally comes down. Okay, now I'm going to bring you back a little bit to the basis of technical analysis, where it all started. Now I'm sure you heard this guy named Charles Henry Dow, right? Maybe you probably just know the name Dow because we always hear about Dow Jones Industrial Average, or the Dow in the US, right? So Dow is basically the US index. It makes up of the 30 biggest companies in the US. Okay, but who started the indices? So this is a very interesting story. You can dig down into Wikipedia, or just Google if you can find. But I'm just going to summarize this, right? Because Charles Henry Dow was a journalist, is an editor, one of the earlier, and also the founder for Wall Street Journal. Okay, he was one of the financial journal which is most read today by financial professionals, even until today. All right. So he's a co-founder of Dow Jones and Company as well. So he, Charles Henry Dow, and Edward Davis Jones. So that's why you have Dow Jones Industrial Average. Okay. Now they did not, when they were alive and they were editors in the journal, they did not come up with a theory. All right. They do not say, you know what, I think I found a secret in the market. I'm gonna share with you guys. It's only after the death of these two persons that they are that they are disciples, all right, people who followed their work. That they have written so many articles about the market, right? So these few people here came out with do a research on the articles that he write, and he came out with some principles that guides the market, right? That describes the market. Okay, and these are the principles that I found out in most of the articles that he's written. You can see these principles written over and over and over again. So these people, all right, we have Hamilton, Rhea, and Schaefer. They come up with a thing called Dow theory, right? So technical analysis, okay, is based on this theory at first, okay, because of course technical analysis only boomed or only become really accept or really being used in the 1980s when computer was being developed. All right, so this guy, I mean, it was from 1851 to 1902. That's 120 years ago, right? So of course US market is a very old market lah. Now, so there are basically 6 principles in Dow theory. Okay. Number one, the market have 3 different trends. I think if you are long enough in the market, you probably already discovered this, right? We have prices generally when it goes up, we have an uptrend, and generally when it comes down, it's a downtrend. And when it goes sideways, it doesn't show any direction, for a period of time. Then it's called a sideways trend. Okay, so there are basically 3 different trends. And the market are fractal. That means it can have long-term, it can have short-term trend. Okay, one long-term trend, inside that long-term trend may have short-term uptrends and downtrends. Right? So you can go down into very, very, low time frame, like the minute chart, like a 5-minute chart and 15-minute chart. And in the 5 or 15 minutes, you can already see that trend. Okay, very short-term trend. Okay, and which you may not see it on the weekly chart, because the weekly chart, when you apply a weekly chart, you only see one price. Okay, because every week you see one price. When you put a daily chart, you see every day one price. When you put a 5-minute chart, it appears every 5 minutes. Okay, so the trend is markets are fractal, right? We have the short-term trend and downturn trend. So you need to identify which trend are you trying to catch, right? Are you trying to catch the short-term one, the intraday movement trend? Are you trying to catch the long-term one, or are you trying to catch the mid-term one? All right, so it all depends on which trend you're trying to identify. Okay. Now the third one is, now this is very important. Okay, for traders, we always hold on to this principle, right? Where price movement discounts all news, because price is basically quite leading, right? And information that goes out into the market could be delayed. Okay. Now information with even with a 1-minute delay, right, could be a lot of difference. Okay, if I have an information earlier 1 minute from the rest of the other markets, do you think I will have an advantage or not? Right? Because if I just at 60 seconds, I can make decisions almost immediately, right? If that information is very positive, is very bullish, in that 1 minute I can get in earlier than the rest of the markets, right? So I can get in early 1 minute, and 1 minute later the information goes out to the public, and then everybody start to jump in. But the time I've jumped in much earlier, so I have an advantage, right? So it's really difficult to get really real-time news, because there is no real-time news, right? Anything can happen so fast. Okay, but whatever information that's being received, right? Some people receive information much more faster than us. Some people can analyze much faster than us. They make decisions much faster, right? So for example, they can look at the financial report, a quarterly report, immediately they analyze it within 1 day, and then they make a decision. All right. If we want to wait for the analyst report, we have to wait maybe like 2 or 3 days before the report comes out, right? So again, everybody has, although we are trying to have a level playing field, right, where the market is efficient. Right? So if you go to universities, the professors and economic professors always talk about the efficient market hypothesis, right? Yes, it's true that if the market is really efficient, meaning that everybody gets the same information, everybody, all right, regardless of who you are, if they get the same information and they have the same skills, right, then market is efficient. But right now, information are not being freely available for everyone at the same time. Okay, and everyone does not have the same knowledge and skills. That's why the market is inefficient. And of course, Warren Buffett is always the one who who debunks the efficient market hypothesis or theory, right? Because if it were true, then he will be on the streets, right? He will not be he will not be the richest person. In fact, he says that he will probably be begging on the streets, right? So in technical analysis, we always say price leads all information. So that's one of the reason why a lot of traders, they depend on chart, but they don't look at information or news, right? Because the time the news or information comes out, it's already been discounted in the price, right? Sometimes we're wondering, right? How come the market have very good news about this company, but the price did not go up? It comes down, right? But because if you look at the price before the news comes out, it has probably risen about 20-30%. It's really gone up. All right. So we wonder, hey, why price go up first before the news come down? And you can see, I mean, if you want, you can do almost every stock that has been written, the research. You look at the quarter reports or whatsoever, you find out that if it's really strong and bullish, it's a good information, you will see that price has already moved up. It could be sometimes 2 weeks, 3 weeks before, right? Or if it's a really bad news, you can see the price already starting to come down. Okay, so that's number 3. Number 4, stock market averages confirm each other. Okay, so in order for that particular stock to continue rising, because it's all interrelated, right? For example, if you look at the property sector, if you look at a property counter, right, and if that property counter is going up, but the rest of the other property counters are not going up, and the construction companies are not going up, transportation is not going up, that means there is something wrong, right? How come this one company only goes up? Okay, so to talk about market, if you want to talk about the market, the property market, it has to be generally most of the property shares or the property counters or the construction counters or the transportation counters, they should be going up. All right. So it cannot depend on one or two counters, and that's the reason why he created the indices. Okay. Okay, number 5, trends are confirmed by volume. Okay, so I'm just going to share with you later on with this one, right? So this one goes deeper, right? This is basically like the 6 principles, the basic principles, but when we go deeper, all of these are being expanded. Okay, then you get more analytical tools. Like for example, the market has 3 trends, right? And you talk about fractals, different fractals. So this guy called Ralph Elliott has come up with this Elliott wave theory. If you guys learn about technical analysis, we have these 5 impulse wave and 3 corrective waves, right? So he actually defined it further. Okay, it's all based again on the Dow theory. Okay, so there are many other technical indicators, many technical analysis come from this after because it challenges investors, it challenges traders and mathematicians to come out with a better model, because they already laid down the foundation. Right. Number 6, trend exists until definitive signal proves that they have ended. Now, this is the most difficult part, right? We do not know how or when the market is going to end, right? Then, of course, technical analysis coming later and give you indicators, give you patterns to tell you whether the trend is possibly going to end, right? So, if you look at most of these principles are mostly very price-based, right? It's very, very price-based. That's the reason why technical analysis comes from this theory. All right. So technical analysis is basically this, right? Technical analysis is a study of historical price data, because whatever that we analyze on the price chart, it is historical. They are history. They are done. You can't trade on those counters anymore. You can't trade on those prices anymore. But you can only do research, right? And to see whether the idea that you have or the indicator that you have is beneficial historically or not. All right, because if you have an idea, you have an indicator that developed, and if it did not even work historically, then don't think of it. Don't even think of it working into the future. All right, it has to work historically first. Okay, so of course, long time ago, if you talk about even Japanese traders and even in the Western traders, 300-400 years ago, they've already started trading. Okay, using price charts. For example, Japanese candlestick is probably one of the oldest. I'm not sure whether they are older than that, because it's almost like nearly 500 years old. Okay, and we're thinking, how do they draw candlesticks? Right? Because we are so used to having those candlestick charts on the computer screen, on your price chart, right? And 400 years ago has even paper being created. right? So yeah, it's great. So it's not in paper, right? And of course, really, I haven't really found any writings on candlestick, and to show you, maybe some of the Japanese candlestick book do have, right? They actually write it on papyrus leaf, because paper lasts the old dinosaur paper is on the papyrus leaf, right? They actually draw those candlesticks on that you know on the leaves. Then after, of course, on paper. And then in modern society, we have graph charts, right? When I started 20 years ago, I still remember um, that this person who used to trade in one of the futures broking house, right? He was trading palm oil futures, mostly palm oil futures. So that time he doesn't have a computer, so he actually draw the price chart. He did not draw intraday because there's no time, but he draw those candlestick charts daily, right, one by one. Okay. Um, so until he retired, he was, because he was not well versed in computers, he did not want to use computer, he keeps on drawing. Then he told me, you know what, actually it's better for you guys to draw, because at least you understand and you know how the market did that day, right? And you can remember them because you draw it. Okay, when you look from the computer charts on the price chart, it's like, oh yeah, it's there, right? You don't have the emotional aspect into trying to understand what the market did that day, right? So I say, oh, okay, makes sense also, huh? Okay. So I mean, you guys want to do homework, you try to draw a lot, because it's quite good to draw, because you have that four information: open, high, low, close. You just draw them, and then you can understand that pattern better, actually, right? So when we look at technical analysis, it's all about analyzing that historical price data, right? And we try to come up with ideas and solutions and indicators, so that you can use those tools to make trading or investment decisions later. All right. So do analysis. You can do price analysis based on art and science. All right. Why I say arts and science? Because science are all mathematical formulas, right? You can put indicators, you can calculate it mathematically, you can put statistical formulas, so it becomes quantifiable. But there are also technical analysis based on art, based on patterns, because patterns you can't calculate, right? For example, there's a pattern called a cup and handle. There's a pattern called a double top, double shoulder, double top. Okay, there are patterns called head and shoulders. Right? So how are you going to calculate head and shoulders and double tops and double bottoms? You can't, right? So they are pattern based. Okay, so there are two types of analysis: patterns and mathematical indicators. Okay, so these are basically used to go and analyze the market, so that you can have different possible outcomes, right? And every indicator basically gives you different indication about the markets, right? So that's why you have a flood of technical indicators in the 1980s. Why? Because that's when personal computer is being used the most, right? Because you can easily do a test on historical data by keying the formula into the software. The software will test for you for 10 years, 20 years, 30 years, just in a matter of a few seconds. You can get the results and see whether that indicator works or not. All right. Imagine without computer, how are you going to do that idea? Right? You put a formula and you test it on the chart for 20 years and draw that manually. It's going to take a long time. All right. So that's the reason why 1980s we have this indicator boom. Okay, because of personal computers. So we do have a lot of technical indicators, right? So, but what's important? I'm just today alone. I want to share with you what is important in a price chart, all right? Because then when you look at the indicators, you basically know what to look for. Okay, and this is the most important part in technical analysis. All right, so I'll share with you. So technical analysis is all about like figuring out in the past, so that you can also, once you see the same pattern, the same indicators in the past, you will expect possible outcomes in the future, right? So it's like a number series game. It's like, when you put in puzzles, you try to figure out what's the next puzzle, and so on and so forth, right? So that's what technical analysis is all about. So it's basically analyzing price movements. Okay. Now I also do not know why they call it technical analysis, right? They should just call it price chart analysis, but maybe price chart analysis is a little bit difficult to say lah, right? But why technical? Because some of the qualifications, right, in technical analysis is like certified market technician, right? So if you give this card to anyone else, they'll be wondering, hey, what do you do? You're a technician, okay? Or you have this, chartered market technician from the US, right? CMT, market technician. So what do you do, right? Are you a technician? It's always the same thing. Because when I started as well, I know this guy called who has a CMT, qualification. I was wondering, hey, got this kind of qualification, one, a chartered market technician. I thought you guys are just a chartist, but right. So I don't know really where the word technical come from. Also, but we all have been also so familiar with it. Technical analysis is basically price chart analysis. All right. Now, this is the most important part in the charts. All right, support and resistance. This is the holy grail, okay, in price chart analysis, if it even exists. Okay, there is a holy grail. It is support and resistance, but there is no holy grail indicator. All right, we are trying to find indicators. We're trying to build indicators, trying to find these two most important levels: support, resistance. I'm going to explain to you why. All right, so that you understand next time when you use the other tools, you understand why these tools are being used. Okay, so it's all about, again, demand and supply, right? So the interaction and transaction between the buyers and sellers will set the price direction. Okay, now, before we start, right, again, one of the things that we want to learn technical analysis is, one of the objective is to basically understand the mechanics, the reasons why, right, price move this way or price moves that way. The reason why indicators are giving you that indication, right? You have to continue to ask why until you know the answer. Now, how do you know the answer? Is until you dig deep enough to understand, remember, the two main characters, right? The buyers and the sellers. Okay, that it ends there, right? The buyers and sellers are basically demand and supply. Okay, so we need to know, first of all, the characteristics of buyers and sellers. Now, we all know, number one, buyers normally wants to buy at low prices. All right, um, it's natural. Okay, we want to buy. Okay, we always want to buy at low prices. It's already ingrained. So that's why sometimes it's very difficult for us to make a decision to buy when the price are high. All right, because we all think that your price high already, how to buy some more, right? How high can it go some more? Okay, that's the mentality of a buyer. And of course, for sellers, they always want to sell at higher prices. Okay, they don't want to sell at lower prices. Why? If I sell at lower prices, I'm not going to make money, right? And if I'm a buyer, if I'm going to buy at high prices, I can't make money as well. Okay, so I need to know where. Okay, I need to know the characteristics of the buyers and sellers before I buy. So this is what you have to remember first, right? Buyer has a mindset that they always want to buy at lower prices, and sellers always have a mindset that they want to sell at higher prices. But of course, this mindset can change, all right, depending on the prices, and prices affects buyers and sellers emotionally, right? Later, I'll give you an example of a trading plan, at the end of the session. So stay with me until the end, because really want to see how it's being applied and how it affects buyers and sellers' emotions. All right. Okay, I'm just going to do a very simple simulation here, right? This is the simple one, assuming that the market only has a few players. Okay, now we want to assume, let's say, ourselves as a buyer. Now we are a buyer. Okay, so I want you guys to assume right now that you are a buyer. Okay, can you do that? Not seller, buyer. So think of yourself now as a buyer. There's another seller out there. Okay, so whenever we want to make a transaction in the market, the buyers and sellers have to agree to a price, correct? If you don't agree to a price, then you will not get a transaction. Okay, so that's why when you start buying or selling shares, the first thing you go is your screen, right? Your bid and ask screen, or your buy and sell screen, where you have buyer's price and seller's price. Okay, and you see they are not matched. Why? Because the numbers of buyers and the numbers of sellers, the prices that they want is different from the prices that the sellers want. Okay, but they'll come to an agreement, right? There's always the best buy and best sell, normally about one price difference or one tick difference, right? So it depends, right, whether the buyer willing to buy at the seller's price or not. Okay, so I give you an example here, right? So let's say the seller right now here wants to sell at 102. Okay, 1 ringgit and 2 cents. But you, okay, say I lah, right? I wanted to buy at 1 ringgit. Do you get a deal? You don't, right? And because you think that, yeah, no, I will not, I don't remember, buyer always think of buying at low prices, right? You'll be thinking to yourself, no lah, cannot buy at 102 lah, wait for the price to come down at 1 ringgit lah, right? And because that commodity that we want to buy is basically getting good demand, then suddenly another buyer comes in, and let's say a buyer, and this buyer buys all that's available at 102, the seller's price. So 102 is finished, all right? And say, oh yeah, finished already. Yeah. And then the next seller comes in, right? And they want to sell it only at 104. And then here we or I still waiting to buy at 1 ringgit. Okay. And I'll be thinking to myself again, should I buy at 104? Maybe it comes down at 1 ringgit. Like maybe there's not much people is going to buy, the price is going to come down back, and the seller will sell to me at 1 ringgit. Okay, lah, never mind, wait first for a while, right? Okay, then another seller, the third buyer comes in and buy everything, right? 104, finish, nothing left with 104. And now we only have 106. Oops, sorry, go the wrong side. Okay, now we only have 106. Now, how many of you have experienced this situation before, right? If you're looking at the market intraday, right, it's always like that. Okay, the first thing that normally a lot of people do is this, maybe including you yourself. I do the same thing, right? In the morning after like 9 something, 9:04, 9:05, when the market started, we always look at the top volume counters, right? Then we try to look at counters that's moving, and then we try to trade those counters, right? And this happens, okay? Rahman Mustafa, no, the live started at 8, all right? So you can review back the recording later if you missed the first part, but we are just starting lah, so not so bad, okay? So let me continue. So again, we are thinking, yeah, no lah, maybe if I buy at 102, someone will sell to me, so maybe I put at 102. Okay, doesn't matter, right? The price keeps on getting bullish, more people want the particular counter, the price keeps on getting higher because the buyers keep on taking the seller's price, buying at the seller's price goes up, okay? And then now we only have 108. Can you be thinking to yourself, oh, it's going up higher and higher? And you look at the market volume, it's like, what, that day is the most active counter, everybody is buying, but how come am I not buying? How come am I not in? All right. And then we have this thing naturally as a buyer, right? Although that we want to buy at lower prices, but there's another emotion that is more powerful than this emotion of buying at lower prices, and that is FOMO, okay, which is the fear of missing out. FOMO. Okay, so because there is an opportunity, everybody has been making money except for yourself. Okay, that's just you okay lah, never mind lah. You know what? I decided to just buy lah. Okay. Okay, I'll buy at 108. Okay, so then we end up buying at higher prices. Okay, why? Because there's always this peer pressure. There's always this FOMO. Okay, most importantly, it's FOMO lah. Okay, and later I'll give you an example. Right? Why is it important that you go in at least at a good price and time? Okay, so it is bullish when buyers are continuing willing to buy at higher prices, because remember, buyers' emotion is always buy at low prices, but if they are willing to buy at higher prices, then it will set that bullish trend. Okay, it's an emotion, right? Those who have been bearish, like the earlier example I give you as a buyer, can turn bullish as well, because we do not want to be left out in that trend. Okay, so if they continue to be willing to buy at higher prices, then prices will go up higher. Okay, so in the bearish market is when the sellers are willing to sell at lower prices. This is the total opposite mentality lah. So I got no time to actually explain the bear side, but basically the emotions are the same, except that it is the opposite direction. All right, it's the opposite. Okay, so now what is support resistance, right? Now, when I always ask this question, right, because a lot of things when we learn about technical stuff is all those technical jargons like support, resistance, right, consolidation, like bullish, bearish trend, like pullbacks, like rebounds, so many of these, right? But what does it really mean in layman's term? Okay, For example, what is support? Oh yeah, support means is the floor, lah, right? Price cannot go down that level anymore. But the question is why the price can't go below that level, right? You have to remember I told you continue to ask why until the answer goes back to the buyers and sellers. Then you really know the meaning of the indicator. Okay. So why support, right? So we know that yeah, support levels are priced when the price is at the lowest. Okay. A resistance level is like a ceiling. The price will find difficulty for it to break. That's why it's called a resistance. Okay, or it could be the highest price. Okay, but why? What sets the support and resistance, right? Why do these levels exist in the first place? Okay. Now if you want to really look at it, right, which I'm going to explain in a short while, is this. Now, support levels are price levels that attracts most buyers. Okay, the reason why it cannot go down lower is because when the price go down to that price, suddenly it attracts a lot of buyers. And when there are most buyers wanting to buy at that price, the price will not be able to go down lower some more. You got that? Okay. So it's very important to know it attracts. Of course, these levels can move up and down, right? Depending on where these buyers are. Because the only problem is this, right? If you really want to know what price that these buyers are going to buy this particular counter, we have to go and ask each and every one of these buyers, which is almost impossible, right? It's impossible. So we can't, right? Because if you really know the buyer's price, then it'd be fantastic, lah. So only God knows, right? And remember, buyers, although they are buyers, they want to buy at different prices. Every buyer will have a price where they want to buy that particular counter. If they really target, for example, a counter, they know what price they want to buy. And that price that they want to buy can change depending on market situation, depending on information that they receive. Okay. But when the price moves to a certain level, suddenly somehow it attracts most buyers. Okay, so that's why price cannot go down. Now, same thing for resistance. Resistance are levels where it attracts most sellers. And that's one of the reasons why price cannot go up, because once the sellers start to come in and sell, the price will have difficulty going up. It becomes a resistance. Okay. Now, to explain further, I'm going to bring you to the screen. Now, this is a bid and ask screen, or the buy and sell screen, which most of us look at when we want to buy and sell, right? We see the price, we see the buy price, we see the sell price. Okay, the top one is the best buy and the best sell. So if I want to buy right now, this particular counter, right? I want to buy now. Can I buy at 110? No, I can't, because there are already 500 people or 500 shares that are waiting, queuing to be bought at 110. So if I put 100 lots at 110, then the quantity will go up to 600. Okay, and I have to queue, right? Until the sellers going to sell to the 500 people, then only I will get that price if the sellers want to sell at 110. But if I want to buy right now, okay, I have to buy at the seller's price, which is 111. Okay, that's the best price. So the top one is the best price to buy and sell. Okay, and I can only buy 300 quantity. So the next thing that you see is the quantity, the buy quantity on the left and the sell quantity on the right. This is the number of shares that is waiting to be bought on the left, and the buy quantity. And the sell quantity are shares or number of shares that are waiting to be sold. All right, and these are all orders that's being keyed in. Right? For example, if I want to buy this counter at 108, okay, let's say I buy 100. So I key in 100 shares, okay, at 108, click enter, okay, click buy, okay, and then that 900 quantity will become 1000. Okay, the 108, of course, there. So but then there's no transaction because the seller's, the best price that seller want to sell is at 111. Okay, so this is what is being keyed in. Okay, but what we don't see is the real number people wanting to buy and sell at this price. Okay, sometimes they don't put in the queue, the orders there. They just wait for the price to move to the level, and once it goes to that price level, then they buy immediately. Okay, I call these the hidden queues. All right, the hidden queue. So there are other numbers out there, okay, which is not displayed on the queue section, because the one is alternative, right? You want to key in to park there and you don't want to see, right? You want to queue into the system, you key it in. But there are many who do not want to key in. Okay, Financial institutions, big institutions normally do not want to key in. Why? Because if they key in and put the numbers there, it will scare a lot of people off. Okay, like for example, if you put the numbers there, if you can see, for example, there's 5 million shares instead of 2,000 waiting to buy at 107, would you be scared? All right. Then, if you can see a sell at 114, then 2.3 million waiting to be sold there. Okay, now, but if I know where they are, right, will it be useful? Let me ask you this question. If, right, that's what the question is, if you know where they are. If I know for certain that there's 5 million shares want to buy at 107, and I know for certain that there's 2.3 million shares waiting to sell at 114. Now, if I know this information, then trading for me is very simple. Okay, I will buy when the price goes near 107. Maybe I'll buy at 108 or 109. It doesn't matter, right? 108 or 109, because I know that the price will never go below 107. Very difficult to go below 107. Okay, and then when the price goes up to, let's say, 112 or 113, I will start selling, because I know that when it goes to 114, it's going to be difficult to go above 114, because that's where it's going to attract a lot of sellers. All right. So you will not be able to see this real support and resistance level right now. Only God can see. I call this the God eyes view, which we don't have, like we are all humans. All right. We can only see these levels historically. Historically, we can see, right? Because when the price goes down to that level and never go down anymore, okay, and then the price starts to go up, historically we can see. But it is history. I cannot make decisions to buy at, let's say, 107 anymore, the low anymore, because it's already done. Okay, same thing if the price forms a resistance as well. Okay, so the holy grail is there. The holy grail is this number of people or these price levels where it attracts most buyers and sellers. But the question is, how good are we trying to identify these levels? Okay, and that's the reason why we develop many different indicators. Okay, number one is to identify this, because once you are able to identify the support and resistance, you can know what's the trend also. All right, and so on and so forth. So I'm going to just bring you in and basically share with you how these support and resistance levels are being drawn. All right, so historically, right, so if the price comes down, for example, when the price continue to go down, there is no support, right? But the moment the price starts to rebound, that means we know that there is support. But remember, I told you this support level is historical, right? It's done, it's history. I can't do anything. Okay, and then when the price goes up, there is no form of resistance, but when you start to pull back, okay, significantly, it can be a resistance. Okay, that resistance can be permanent, but there's no such thing as permanent resistance or support, or one day it will be broken one, right? We may have permanent support levels in the long term, but not permanent resistance levels. Why? Because generally for stock markets, most of the good companies will continue to go higher and higher and higher, but the price will never go back to its previous low. All right, unless there is something wrong with the company. That's why I say it's only for good companies that still continue to grow. All right, so these are support resistance levels. We can identify them historically. Right, now the biggest challenge is this, right? So we know where they are historically. Can I find where are the future support and resistance levels? Okay, that's the billion-dollar question. All right, so next question is, how do you identify them, right? Okay, now there are many different tools, and sometimes markets are not so straightforward. Okay, now when market goes sideways, it means there is no trend, right? It goes up, it goes down, goes up, goes down, but generally it's just moving sideways. You need to understand the trend first before we try to identify support resistance. Okay, so now if you really want to dig deeper into why price moves sideways, okay, you have to dig deeper again, right? Ask more questions why, then you have a lot of reasons why. Okay, and normally price goes sideways because there is no information, there is not much news covering this counter, there's not many people know about this counter, volume very low, there's nothing much exciting about this this company, right? The results has been the same, not much growth, nothing much is happening, price goes sideways. All right, just ding dong sideways. So that's one. That's why the price goes sideways, right? Sometimes the price can trend. For example, then a boring company that doesn't move that much, got no information whatsoever, then suddenly have something positive. We call it a catalyst. I'm sure you heard the word catalyst, right? So catalyst can be bullish or bearish. For example, even if you look at just a recent example, glove companies, right? If you look at Top Gloves, you look at Hartalega, you look at most of the top or the glove companies. If you look at the share prices, they have been declining over the past 2 years, right? Because it's competitive. The demand is not as strong, right? They can't produce that much. It's almost, there is growth, but the growth is not as strong, right? Um, the major catalyst for them is basically what? It's COVID-19. Okay, not just any health crisis will benefit these companies, because that's when the demand for gloves will start to happen, will start to really become very strong. This time is super strong. Why? Because this is unprecedented, right? We have seen SARS before, for example, right? And SARS do help prices or demand for gloves to go up, and the share prices go up. Okay, but this one is really unprecedented. This is one of the longest pandemic, and it affects globally, and until people, until countries go into lockdowns or shutdowns. All right, so that's why this is a major catalyst for the glove sector. Okay. But sometimes the market just goes sideways, right? So today you can actually see quite a number of companies that has very good positive catalysts. So a bullish trend is simple, right? When the highs are getting higher, the lows are getting higher, we have a bullish trend. All right, that means the resistance levels go higher, the support levels go higher. In a bearish trend, the lows get lower, the highs get lower. All right, this is normal. So again, Dow theory has only 3 trends, right? Down, up, or sideways. The reason why there's an uptrend is because there is a continuous positive catalyst that's pushing the prices up. All right, it could be the sector, it could be the industry, it could be certain factors that affect that particular counter. It could be also improvement in its efficiency. There are many factors, right? So as long as the company is doing very well, the share price will normally continue to go up. All right. Okay, now one of the ways to identify support resistance is to draw a trend line. Okay, a trend line is a straight line. So what we are trying to do, this is a very basic, right? What we are trying to do is to identify the next support and resistance levels in a linear manner. Okay, linear means is a straight line approach, straight line manner. Okay, but of course the market can be complicated sometimes, but sometimes it is very clear. Sometimes it can be as linear as possible, right? I'll show you examples later on. Okay, now for example, linear means, you look at you remember I showed you that number sequence or that puzzle, right? So if you look at this sideways trend, for example, sideways trend is very easy to identify, right? For example, you look at this price movement here, whenever it goes 1 ringgit, it rebounds back up again. The moment it goes to 120, it cannot go higher, it comes down back again. So for the past, in this particular period here, the price has been trading between 1 and 120. So basically the support level is 1 ringgit, doesn't it? Right? 1 ringgit flat. And we know that resistance historically is 120. Okay. Now, you would expect the support and resistance to remain the same at 1 to 120 if there is no further catalyst, whether it's good or bad catalyst for this particular counter. That means it would just remain the same. Okay, this will change if suddenly the company reported very good results, or suddenly the industry changed, or suddenly the sector has changed. Then it will affect. So if there is no catalyst that's going to affect the price movement in this particular counter, if it's still very quiet, then it's going to continue remaining trading sideways. Okay, then it's easier to trade these counters, and there are quite a number of counters that trade sideways. If you know how to find it, right, you can actually just buy at the support and sell resistance, right? Of course, it's not exactly at 1 ringgit in this case. Like it could be like 102, 103, but no, when it goes near the support level, it's time to buy. When it goes near resistance level, it's time to sell. Okay. As long as 1 ringgit still attracts the most buyers, right, and 120 attracts the most sellers. Okay. So if there is a positive catalyst, right, something which is very bullish, the sellers would not want to sell it at 120 anymore. Why do I want to sell at low price? Because I know that this price will going to go up. I know that it's bullish, right? So I'm going to sell it at 150 or 160 or 170, right? Then the resistance level will go higher. Okay, so this is a bearish, this is a sideways trend, right? Now, in a bullish trend, of course, generally the price goes sideways. So in a linear manner, it's quite easy to identify, right? You can draw the line if you want to, but you can just do a very simple mathematical solution over here. For example, you look at the top one, the resistance, right? Why resistance go higher and higher? Because remember I told you, if the market catalyst is bullish, initially 120 attracts most sellers, right? That's why it cannot go above 120. But as the market continues to be bullish, as you know, there's always continuous demand for this counter, the sellers will, most of the sellers will not want to sell at 120 anymore. It will be at the next higher level. Okay, so the next higher level that they sold, most of them sold was 123. Okay, and so on. Okay, let's say 126 until. Okay, the support level has increased from 1 ringgit. You know, it's like, for example, remember I give you the example of buyers. Okay, we missed out and say, you know, if I don't buy, if I only want to buy at my price, I will not be able to buy the share. So I have to be willing to buy at higher prices. So the support level goes up as well whenever there's a bullish movement. Okay, so from 1 ringgit, 103, 106. So if you just look at this number sequence, right, you could just possibly just, you know, roughly estimate where would be the next support resistance. For example, if you look at the resistance, right, 120, 123, 126. So what's the next number? You just add 3 cents in it. So 120, 123, 126. The next number will be 129. Okay. When you look at the support, is 1 ringgit, 103, 106. So the next one is going to be 109. Okay. So this is basically a straight line method. All right. So you can actually draw a line, right, at the bottom and the top to determine where is the next support or resistance. Okay. So because we already see the trend historically, right, and we're going to expect this particular trend to behave the same manner moving forward. Okay, so that's one reason why we draw the trend line. So, and because the trend line is a straight line, so this is a straight line forecasting method. All right, to determine where is the next support or resistance. So if I know where the future support and resistance levels are, okay, if they are really there, then trading will be very simple for me, isn't it? I'll just buy when the price comes down to the bottom line, the support line, and then sell when it goes resistance line. That's the idea. All right. So when the price goes in a bearish trend, it's the same thing, right? So it goes down lower and lower. So when you draw a trend line, right, at the bottom and the top, then it forms that trend line that's going down, and that will form that support and resistance in a downtrend. Okay, so what happens when it breaks out from that? For example, let's say we expect the next support level or the next resistance level. You look at the top one now, 98 cents, 96 cents, and let's say the next resistance level is at 94 cents. But suddenly the price breaks above 94 cents and go to 95 cents, 96 cents. So what happens is, if the moment the price breaks out that resistance, because we were expecting that line to be resistance, right? But the moment it breaks out above the resistance, it simply means that, you know what, the resistance is not there anymore. I was expecting it to be there because based on my straight line forecast, it's supposed to be there, but it is not there. The reason why it's able to break above that 94 cents is because there is no resistance. The resistance may have gone up higher. So we call this a breakout in the trend line. All right. So now this comes to a very important, important fact in trading as well. You know, when we look at technical analysis or price chart analysis, there are basically just two main strategies that you can actually trade. The first one is buy low, sell high. Okay, buy at support, sell resistance. Like for example, on this chart that you see here, you buy at 92 cents, you sell at 96 cents because you expect 96 cents to be resistance, not going up anymore. You sell there. That's buy low, sell high. Okay, the other one is buy high and expecting to sell higher. We call it a breakout strategy. Okay, the first one is called a reversal. The second one is called a breakout. But there are many trading plans for reversals. There are many trading plans for breakouts. Okay, because there are many indicators that you can use for breakouts. There are many indicators you can use for reversals. Okay, so breakout, like I said here earlier, now this is a downtrend. As long as the price stays inside that trend line, it's a downtrend. But the moment it breaks out, that trend is over. You're expecting a new trend, right? A breakout in the trend. Does it make sense so far? Okay. Okay, so how do you draw trend lines? You first of all need to have two significant pivot points. Okay, the points that forms that V shape on the chart. So this can be, you can do it scientifically if you really want to have a precise definition of a pivot, or sometimes you just look at it on the chart on your eyes itself, on your using your eyeball. You can actually see whether the price is having a pivot or not. All right. Like here, for example, so I'm just going to put in a few examples before we go and look at further example, the strategy, right? So you need to, first of all, see 2 points, right? So once you connect the 2 points, you just draw that line exponentially, okay? And we expect the price to continue to, as long as it stays above that trend line, that means that trend is considered still bullish, okay? And whenever the price goes away from that trend line, that means it has gone too far from the trend, okay? The opportunity comes when the price pulls back to the trend line. Okay, later I'll give you a better picture, but what right now is to basically know how to apply the trend line first. Okay, so like here, for example, you see the trend line is going up, you can actually draw a trend line that's going up at the bottom. Then now if you don't have 2 levels or 2 points at the top, right, at the resistance levels, you can actually just draw a parallel line from the bottom line. Okay, from the green line, you just like do a copy on the green line and put it at the top, then it becomes a channel. So same thing here. When you draw a trend line like this, we're expecting the price to continue to go into an uptrend as long as it stays within that support and resistance line. Okay, we call it a trend channel. All right. So downtrend, same thing. Select the 2 main pivot highs. Okay, draw a line and just draw it exponentially. Then you should be able to see the downtrend. So as long as the price stays below the downtrend, below the trend line, that means the trend is still going down. It's still bearish. Okay. Okay, so you can draw a channel as well. If you only have 1 point at the bottom, you can just copy the line at the top, draw a parallel line and do it at the bottom. Okay, so now you notice that when applying trend lines, you are basically trying to figure out a linear method, right? Of trying to determine where is the trend, where is the support and resistance levels for that particular trend. All right. Like I said earlier, the market may be dynamic, and the trend line, of course, if it's just a straight line manner, may not be able to define all the trends correctly. Okay, that's why we need other tools as well. All right. So what will be the trading plan? So this trading plan, let's say I want to buy low, sell high, right? So first of all, you determine where's the support level or resistance levels, right? So you draw a line that's connecting the bottom, the 2 bottoms at the bottom, and then you connect the 2 tops, to draw that resistance line, and that form that support and resistance, right? Because remember the red line, which is the resistance right now, that's where you're expecting it will attract most sellers, right? And that's when you think the price may start to come down. Okay, when it goes down to the green line at the bottom, that's when we expect it will attract most buyers by using a straight line method. Okay, so in other words, where would your strategy, where would the trading plan be for this, right? So the trading plan for this is very simple. Okay, because number one, you know that as long as the price stays above that green line, the trend line, that means the trend is still bullish. And whenever the price pulls back or comes back to the green line, the support line, I expect that level to attract a lot of buyers, and price should not go below that, right? And that's when I'm going to buy. Okay, so I'm going to buy when the price near support line and it start to rebound. Okay, now the rebound definition can be a lot also. For example, if the price continue to be like every day going down, down, down without going up, that means there is no rebound. But if it goes down, 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 and suddenly it turns up today, that could be a rebound, but that's a 1 day rebound. And sometimes it can be a false rebound. Okay, sometimes people use like 2 or 3 days rebound, but you cannot do too long, because if you do like, for example, a 5 days rebound, that means after going down so many days, after 5 days it goes up, then only you buy, right? And that could be sometimes too late. Okay, so to get that nice or best figure, of course that would be a challenge, right? And it's continuous, we try to find the best solution, right? So buy when the price nears support line and rebound, and then for selling, I sell when it nears resistance line and pull back, because that's when I'm going to start to expect a lot of sellers come in. That's when I'm going to sell. Okay, now I'm just going to give me another 5 minutes. I'm going to be done, and then I will answer your questions. So if you have any questions at all, just write it down. Okay, now I'm just going to give you one example how you can apply the trading plan, right? I'm just going to not only just how you can apply, but see how people respond to a price. Okay, let's say we have a stock, we have a counter here. This price is real, right? This is a real counter in Bursa Malaysia, but I just take off the price, because if I put I take out the name, because if I put the name, then you probably could figure out what counter is this. Okay, but I think Some of you could probably also identify this counter without putting in a name. So if you guys know what counter it is, you can just type it in. Just for the sake of having some fun. Okay, so you can write the counters down. If you know. Okay. Now what happens is this, right? So now I'm trying to apply the trend line and find where is the next support or resistance. So again, you draw a line that connects the two bottoms, right? That's the obvious one at the bottom there. Okay, and then you can draw a parallel line, which is the line same at the bottom, and just put it at the top, because you already see you only see one resistance. I haven't seen the second resistance. Okay, so if you draw a trend line like this, you'll see that the current price, all right, let me just put a a pointer here. The current price here is the highest it went was 70.5 cents, all right, and that price closed at 68 cents. Now I know on your screen maybe the price the screen may be a little bit small to see, but you know what, you can actually download the slides later, and I'll show you how you can download the slides. All right, so the price is at 68 cents, and we know that 68 cents is quite is quite near the resistance line. Okay, and the price is nowhere near the bottom. Okay, so the thing is this, right? I want to buy low, sell high. That means the only way you can buy low is when you wait for the price to come down, because that's when you buy low, right? If the price is going up, that's not buying low anymore. You are buying high, expecting to sell higher price. Okay, now look at this. Now at this price, you see at 68 cents, when the price already move up, okay, from the bottom here at 55 cents, right? It has gone up about 13 cents to 68 cents. Okay, for 50 cents to go up to 56 cents counter, go up 13 cents is almost 20%. All right. So already gone up 20%. Now you look at this particular day, can you see the volume? Okay, is particularly high. Okay, so what does it mean? Okay, now if I want to follow my trading plan, I will not buy at current price. I will buy when? Remember, the strategy is to buy when the price goes near the bottom line, the green line, not near the top line. But if you look at the chart, you'll know that there's still a lot of people trying to buy at the high. Why? Look at the volume. It's crazy high volume, and the price is high. Okay, that means we know that there's actually a lot of people still buying at that high, knowing that if of course I'm also trying to just forecast, right, that the current price is at the resistance level. Okay, so let's say trader A and B bought at 68 cents. Why? There are a lot of people who buy at 68 cents, right? Well, there's a lot of volume there, so we're assuming that A and B, I don't know how many people actually bought. Let's say there are people buying at 68 cents. I want to show you how prices will affect the emotions. All right. Now, after they bought at 68 cents, the price did not go anywhere. It continued to go sideways, and then it closed at 65 cents after 1, 2, 3, 4, 5, 6. After 7 days, it is not moving anywhere. Okay, they expect the price to go higher, but it did not go higher, right? See, when they buy 68 cents, they will expect the price to go even higher. Okay, but after 7 days, the price just stay flat and it closed at 65 cents, and now it's down 4.4%. So trader A and B will be thinking, okay lah, the price goes sideways, right? It hasn't gone down yet, so not so bad lah. Okay, the price may still go up, right? And they're hoping that the price is going to go up. If I'm following the trading plan, I will wait for the price to come down to that lower trend line, which is at about 56, 57 cents. Then only I will consider, right? Because now the price is high. So I will not consider. Now, next few days, the price went down to 60 cents. So now 11.7%, because we bought at 68 cents. Right now it's 60 cents. They're already down 11.7%. Okay, so A and B still holding the share, be thinking, ayo, now what to do? Should I hold or should I sell? Okay, so trader A decided to sell. Say, hey, can't take it anymore, right? I'm already down 11%. If the price go down some more, I'm going to lose even more. All right, so I'm going to exit at 11.7. I'm going to exit at 60 cents. So A exited. Now we only have left B. B continue to hold. All right. So at this price now at 59 cents, B still holding, but the price has come down to 59 cents. Now B has a paper loss of 13.2%. And then trader A says, wow, lucky I sold. I only lose 11%. If I keep on holding for one more day, I lose 13.2%. All right. So now, as a trader, if I'm going to follow my plan, I'll look at this price. Oh, you know what? The price is now near the support level. Now I think it's time to consider. Okay. But I will not buy now because if you look at the price chart, it's been black candle, black candle. Black candle means the price is going down, 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 down. So I may want to wait for a reversal. Okay. So I wait for a reversal, and the next day the price actually reversed. Okay, and it closed at 63 cents. Right. So now C and D, assuming that now I'm, let's say, either C or D, it can be anyone, right? You decide which one you want. Okay, C or D. We're going to buy at 63 cents. Now only starting to buy, right? Because the price actually rebounded. So the rebound from the support level actually provide an evidence that there is support at that low at 59 cents. All right. So if I'm going to buy this particular share, I'll tell myself, you know what? 59 cents is that support level. Okay, that's when the price rebounded, right? It didn't go below that level. So I will put a stop loss at below 59 cents because the moment the price goes below 59 cents, that means 59 cents support level is not there anymore. I'm wrong. I better get out. Okay. So now let's take a look at this. Now the price is at 63 cents. Trader B, remember the earlier one who bought at 68 cents, is still down 7.3%. Okay. We are just, so C and D, let's say we are C or D, we just bought 63 cents, so no price movement yet, right? So we don't do anything yet. Now let's see what happens after this. After another 2 weeks, right, the price went up, we happy a little bit, right? It went to 68 cents, right? So if you went to 68 cents, if traders C and D exited, they could already make some money, right? If trader B, who got in much earlier, even if they exit at 680, he only breaks even. You see the horror that trader B has to go through just to break even, right? Or go back to the price where he bought earlier, especially when after that, when the price comes down. Okay. Now the price came down to 61 cents and then go to 59 cents, right? It tested that support level once again. Okay, it did not break below 59 cents, right? It just stayed at 59 cents and it rebounded a bit. Okay. So what happens is B cannot take it anymore because he bought this share 1 month ago, right, at 68 cents, and it's now going back down to 60 cents, 61 cents. I had enough lah. You know what? 10% 10% loss, 10% loss lah. So B exited, right? Because you don't think so the price is going to go up anymore, because after 1 month the price don't go up. Okay. Then what happens is trader C and D. So now trader C and D, right? Trader C decided to exit as well because you know what? I was expecting the price to go up higher, but the price came down, and for the past 3 days has been coming down, and it's already down 3%. I cannot take it anymore. So let's say trader C cannot take it. He did not follow the plan, right? Because the plan was only if the price go down below 59 cents, I'm going to exit. But now the price is at 61 cents. All right, 61 cents. And the guy already caved in. He gave up. All right. Okay. So now trader C gave up. Okay. And what happened after that? You see that the support level at 59 continued to exist. Right. It continued to attract a lot of buyers at 59 cents. And you see, once it go 59 cents, the price started to rebound and then only started to move. All right. So those who bought earlier all got shaken out. Okay. I think if you've been trading, you also feel that sometimes you are one of those who's being shaken out of a movement. Okay. But as long as you follow a plan, as long as you follow something, a trading plan, then at least most of the time you will not be fallen into that trap. Okay. So trader D, who bought at 63 cents, let's say the price now, when the price goes to about 78 cents, it reaches the resistance level. And if I'm a very disciplined trader, I'll tell myself, you know what, I'm going to exit at 78 cents, make a 23.8% profit, and exit. Okay, that's it, done. And guess what? After this, at 78 cents, if you sell at 78 cents, this particular stock, the price went up to 90 cents. Right? So if you have to hold a bit longer at 90 cents, you got to make money. But you have to remember, you see the journey, right, that takes from when the market goes up a new high until today. You know how many people has lost a lot of money, right? And if you can already make some money like this, you should be thankful. You should be contented that you can make this 23% in just a month, right? And all you need to do is to continue using that strategy on other stocks, right? Continue to use it. Okay, so this is basically, of course, one strategy, right? And this is a linear method. So there are times when it's very difficult to identify these support and resistance levels. We use other indicators. For example, one of the indicators you can use is a moving average. Moving average is not a straight line method. It's more, it follows prices. So it's more agile. It's more dynamic. Okay, but I just want to leave you with this first to give you an idea, right? How important it is, and and how it would affect you um, at prices that you trade, right? The worst time to trade, and it's always very difficult to manage, is when you're buying at the high price, because for it to recover back, if it goes down, it's going to take a long time. If it does not recover and continue to go down, you're going to lose even more money. All right. The worst the person lost, trader C lost, was about 3%, right? If the price continue to go lower, not 10%, not 15%, right? So it is good if yeah, sometimes you have to be patient enough to wait for at least the price to pull back. Okay, and when the price pulls back, goes to a support level, that's when you initiate that buy position. All right. So support and resistance levels are important. Okay, but the only question is this, right? How do we find them? So I've shown you one using a trend line. You go back home, you have to do more examples. Of course, it doesn't work 100% like this, right? You have to do more and more examples to see whether it works or not, and which counter works better. All right, but you'll be surprised sometimes you find that markets really do move in a linear manner. All right. Okay, I'm gonna stop here. I'm gonna take a look at your questions. Some of you guessed some counters, right? Derek Lim, you only leave once. Wow. So don't go Sailang. Yes, you leave once, but you can leave either in with money or without money. So be careful. Yes, FOMO does happen. So whatever I'm expressing, yeah, some of you see I'm being dramatic today. It has to be emotion, right? Because if I just present it like just speaking from the slides, then then you don't feel it. You have to feel it, because market is very emotional, right? You win money, also there's emotions. You lose money, there is emotions as well. Okay. Okay, Aun Zaidi, you're asking, is there a sideways trend most of the time? I mean, when the price is going up and down. Yeah, but the price can move sideways most of the time. No, it really depends, right? Some counters do move sideways, especially blue chip counters, right? Because blue chips are basically very, very high volume. They don't move that much, so they will stay at certain levels. And once the financial reports are out, it's a good report, they will move into a next level. So one time you move a lot, and then you'll stop for a while again, until the next news comes out, right? So it's more like a ladder kind of trend, okay, for some blue chip counters. But if you're looking at very speculative stocks, it trends most of the time. Okay, it only goes into sideways trend in a very short time, and it goes up. So it really depends on that, in each and every counter, because there are different players in different counters. The players who buy and sell 30 ringgit shares, 20 ringgit shares, would probably not want to look at a 30-cent or 20-cent shares. All right, they are different players altogether. So the characteristic of the price movement is also different. So when you do an analysis, you cannot just look at the composite index, for example, right, as a main indicator whether the market is doing well or not. You have to look at that individual counter. So that's the thing. DT Quay, you're asking, if a breakout happened, how do we shift the trend line, right? So you can only shift the trend line one, you have at least two pivots, right? If you only have one pivot, you still cannot shift. You still cannot draw the next line. So you have to have the breakout first, okay? And the price has to go into a trend a little bit, and then find the next support or resistance. Once you have the two bottom or the two tops, then only you can draw. So that's why it's a little bit lagging, right? So there are many ways you can basically you can basically catch that breakout or reversal lah. Holding power low, show kena shaken, yeah. So the holding power depends on your risk lah, right? Of course, if you put all your money in that counter, if you silent all your money in just one particular stock, okay, I don't think so. Even though you think that you have holding power also, but because you're going to lose a lot of money, right? You basically will start to sell as well. Extreme detail explanation. Okay. Yes, Xiaowei, if you fail to plan, you plan to fail. Okay, so if you go into the stock market buying and selling, whether it's for investing or trading, if you do not have a plan earlier, that means you are already planning to fail. Thank you so much for this, Xiaowei. Trader B and C, the horror, cannot sleep. Trader D, eat Musang. Musang King, is it Steven, not Mustang King? Yeah, so it pays lah, all right? It pays to be patient and to follow a trading plan, right? If not, it's gonna be it's gonna be easy, right? If you continue to just try to figure out when to buy and when to sell. Trader A lagi best eat. Okay, so Abdullah Izzuddin, you're asking a question. Just yeah, I forgot to brought out the question a little bit. Suppose a retail investor holds 1 million shares at stock of 1 ringgit per share. After some time, price increased to 5 ringgit per share. How would the retail investor dispose all of his shares at $5, or does he have to ladder up or down due to the sheer size of demand and supply? How would the strategy be? Right, this is a very good question. Okay, again, it really depends on the strategy that you're applying, right? So I'm assuming that from 1 ringgit to 5 ringgit, you are a long-term investor, lah. Okay. Number one, if the price has gone up from 1 ringgit to 5 ringgit, I may not want to sell as long as the fundamentals are still there. Why do we want to sell, right? But assuming that maybe you think, you look at the charts or whatsoever, the price is coming down. Yes, you can sell some first, but it doesn't mean that you can sell everything, right? So it depends on your investment objective. Okay, if the company is still doing well, I will not even want to sell. Okay, for example, I'm just giving you my example, right? If that company is investment grade, that means no matter what, this company still gives me good dividends year in, year out. The performance of the company is still very strong. Okay, as long as the fundamentals are good, I will sell their shares. For example, if let's say it goes to 5 ringgit and you want to sell it, okay, I can sell it, but I will not sell more than 50%. Okay, I'll still keep half of it no matter what. All right. Okay, so on the way up, I maybe sell like 20%, and the last 10% or 10%. It really depends on how. Sometimes I just prefer to do two ladders or maximum, right? Because if you keep on laddering too high and you do not know how the price is going to go, really it depends. Okay. But if I'm a trader, right, normally we have 2 price targets or 3 price targets. So the first target, the second target met, I exit. The third target met, I exit. If the target is not met and the price start to pull back to a stop level, then I get out as well, right? So trading is more on very fast, go in and go out, go in and go out, and that's the reason why if when it comes to trading, make sure that the counter is tradable, right? Tradable means you have high volume and high volatility. Okay. Ong Li Jing, thank you. Clear explanation. Yeah. So yeah, I'm just trying to make it as easy as for you to understand, especially when you look at charts, because charts can be complicated, right? But what we want is basically looking at it, and try to figure out what does the market think. Okay. Raman, you're asking, does high volume generally means more buyers? Can it be more sellers? Yes. When you talk about trading volume is basically just a number of transactions that are being done in that period. So we can't know whether there's more buyers or sellers. Okay. But you look at the price direction, right? So if the price is going up with a high volume, that means of course there are more buyers. Okay. If the price is going down, let's say it's a black candle, then you know that volume has more sellers. Okay. And if that candle is like a doji, right, there's no body on the candlestick, that means there is probably equal amount of buyers and sellers. There are a lot of them, but the strength of buyers and sellers are the same. Okay, so you cannot just use volume alone, but you can use it with the price to indicate, right, whether there are more buyers or sellers in that volume. Okay. All right, so I hope that what you can do is, if you want to know how to how to access to charts, right? Most of the online brokers have charting tools available on their website. So if you open an account, right, there is you can use a charting tool. Or alternatively, if you want a free charting tool online, one of the best ones that I know for free is investing.com. All right. So you just go to investing.com. Not just Malaysian market, but you can have charts and prices for the global market. All right. Anything you can get it there. What about the buy quantity percentage? There is a part in trading platform that shows. Yeah, I mean that shows you the percentage of buy quantity against the sell quantity. But you have to remember, right? It's very deep. Don't use the quantity, right, as an indicator to decide whether you should buy or sell, because the buy and sell quantities are that's the order that you key in, but you can also cancel anytime. Right, so it may not be a real order. So sometimes you see, wow, the sell quantity, right, is, or the percentage is so much bigger than the buy quantity, and they said, oh, you cannot buy lah, like that, right? Because there are more sellers waiting to sell than buyers, so cannot buy lah, right? No, that's not the case, right? Sometimes the price can still go up higher, although you see the queues are very, very thick or very high on the selling side. All right. Because like I said, some of the big investors, some of the big traders, they do not queue it in. Sometimes they just come and just kill all the sell prices without you knowing. The price just jump. All right. So it's very difficult to use that buy and sell quantity, because these guys can also, sometimes they can also trick you, right? They put in a lot of quantity to sell, just to show suddenly, oh, how come got 5 million or 50 million shares waiting to sell out of the blue? Okay. And then you'll be thinking, oh, can I buy some more? Because if no, I don't think so the price can go up above the level. Okay. Now sometimes it can be like that because the person just don't want the price to go up higher, put a roadblock in front of you, right? And when people see it, and when they see that, the buyers are not coming in, then they remove the roadblock. I can cancel the order anytime, right? So they remove the roadblock and then everything go clear again. So I never use the quantity which is being queued on your screen as an indicator. All right. I'm also doing FMVA, financial modeling and valuation analysis. Wow, that's good. If you can, that's one thing that's if you combine both fundamentals and technicals, that's quite good. Oh, Jack Tan, you're talking about already buy and sell one. Oh yeah, so on the screen you can see the percentage buy and sell. You can okay, there are certain assumptions that you have to make and looking at that percentage. It's very hard for me to explain right now, but generally, yes, it can tell you whether there are more buyers and sellers, right? You can look at the trend. I used to do that as well. You can actually see, like, for example, if let's say they are 90% buying and only 10% selling, right? If it continues to be 90% buying, 10% selling, the percentage remain the same. That means that the buying is very strong, right? Then suddenly you see the 90% becomes 80%, and then the selling becomes 20%. And then you see the trend change. You see the momentum of buying is not becoming very weak. So if I'm trading a very short term, then intraday or whatsoever, if I see this weakness, I may want to take profits first, right? You can do that. Okay, if the transacted one is okay. So Jack, yes, the transacted one is okay, right? But there are certain assumptions on the percentage of buy and S. All right. It's very difficult to explain to you, but you can just PM me or put a question as I'll try to give you some examples later on to explain to you. All right, Jack? From experience, what's a reasonable KGA target a monthly trading plan? Okay, if you're Abdullah, if you're talking about stock market, just stock market, right? You know what? My trading plan, I call this a 3x3 trading plan, which is 3 times 3, right? Which is 3 years, 3 times. Okay. In order to do that, I need to achieve a 15% growth every 3 months, not every month, right? If you want to put your pressure to have a 15% or 10% returns every month, then it's going to be a little bit difficult. Because what happens if the stock don't trend even in 1 month, right? All of them are going down. Because I'm talking just about Malaysian stock market, where you make money most of the time when the price goes up, right? Not when it goes down. Okay. So 15% per quarter is reasonable. All right. So if you're able to achieve that 15% growth every quarter, All right. So we have 4 quarters. 1 year is 60%, right? 15 to 60%. But if you compound it every month, every 3 quarter, right? By 3 years, you should be able to 3 times your capital. All right. So that's the objective. That's my objective for short-term trading. And if you do that, it's not much pressure, because all you need to do is to have your portfolio to have a 15% returns every 3 months. That's all. Okay. Slow and steady. If you try to reach for the moon, it's gonna take a longer time. All right. For mankind to reach the moon, they do reach there one day, right? But it takes a very long time. But I'd rather build, let's say, Empire State Buildings or Twin Towers. Okay, it takes shorter time, but at least it can be achieved. Okay, so I can build more Twin Towers. Okay, more Twin Towers rather than just go for one moon shot. Okay, so that's an additional wisdom that I can give to you guys. Okay. All right, guys. So it's already 9:30. I have to end here. I think your questions already stopped. Yeah. So guys, I hope that today's session is able to help you. So next is I'm going to share with you how you can get the slides. Okay. So, but before that, Bursa Malaysia has started this Bursa Academy under Bursa Marketplace. Right. This is where you also be able to get a lot of other learning materials. Right, on Bursa Academy .bursamarketplace.com. So when you download the slide, you should be able to see this as well. So it's already just being built by Bursa Malaysia. You can go there, you can register, and you can get more information and learning over there. All right. So just head on to bursaacademy.bursamarketplace.com. Okay. So now this is where you're gonna get your slides. And we're gonna put down the comment section there. If you can't see the slides, right? The comment section will be pinned there. So you just click on the link. You have to complete the evaluation form. I think some of you already done that. So once you have completed the evaluation form, right? Once you have submitted it, then automatically in the next 2 or 3 minutes, you'll receive an email with a link to download the slides. All right. Okay. So with this, I'm going to end here. Thank you very much for joining us. Next week, we're going to continue with this Bursa Investment Education series. Next Saturday English session, we're going to have the Mandarin session at 8 p.m. as well on Friday. So if you're a Mandarin speaking, investor or trader wants to learn more skills and tools, you can join us on Friday. So make sure Friday and Saturday you mark your calendar at 8 p.m. to join us in this series. All right. So with that, thank you very much for joining us once again. I wish you all the best and wish you a good evening. And we'll see you again in the next webinar. All right. Have a good evening. Have a good night. Thank you.